Well, hi, we're going live here on YouTube. Welcome everybody. A few little flashy things up there. You can see who I am, Livestream, mortgage advisor, CPD, all those good things. Paul Archer, and they've gone. So we've got a nice clear screen for you for the next 20 minutes. Paul Archer, Archer Training, paularcher.com, all sorts of different ways of getting hold of me if you wish to. Anyway, let's get on to our mortgage live stream. Hope everybody's well. We're well into lockdown now. What are we now? March, April, May? I don't know where we are. No, we're February, aren't we? So you kind of lose touch about where you're going. Got a couple of great topics for you I want to share with you over the next 20 minutes or so. Want to keep you up to date with things. Remember, if you want to be kept up to date with the mortgage market and keep your CPD, come here onto the YouTube channel. We've got all our own CMAP training courses on the boot camp where you get structured stuff as well. So enough of that. Let's talk about it later. Let's get on to a couple of topics. First of all, the mortgage market for you. Looking quite good. Obviously, we've got the end of the stamp duty coming up. We know that. And that's slowing transactions down. The mortgage market is slowing down. You can certainly tell, and there's all sorts of pundits saying that prices are going to come down and everything like that. But things are slowing down, and they should do because the government effectively subsidised the market for a few months, haven't they? But the mortgage provisions, or the market for mortgages, is actually improving, which makes it easier to borrow and easier to buy properties. The number of high loan-to-value mortgages is increasing. You can get 90% loan-to-value quite readily now and on good terms. Whether we'll get a 95% lending product coming through soon, I hope so. I think we will after the budget, especially if Rishi does something rather nice to the mortgage market. So lots of good products going on. In fact, when you look at the figures, there's a 42% increase in mortgage products available on the market. How cool is that? Which means that we're going back to pre-March 2020 sort of products, which is great. Competition's good. So what's happening in the mortgage market? Well, something big's happened actually. You probably heard about GameStop and the short selling fiasco. And I'll need a couple of minutes on that in a second. But it's actually a bit more than that. I mean, I like to look ahead at the future. I like to know what's going on. I can look at trends and forecast them in my head. And it's the rise of the small player that we've got to be very wary of moving forward. The rise of the person, the rise of the individual who can obviously gather together using social media or whatever methods in order to become bigger. We're going straight to the consumer now. In the future, we'll see less and less intermediaries, less and less banks doing the marketing and the selling. Banks will become pure lenders in the future. Talk about that another time. Gone are the days when banks cross-sell and all those good things. Current accounts are not making any money from that, so it's time to charge on those, aren't they? So, but that's the biggest change that's happening right now. My son Lewis, he's 26, he's investing in shares and Bitcoin. Talked about that last week. People are doing this now on their own, and that's what caused the issue with GameStop. You might have heard about it. Now I put a little sheet up here for you. Hopefully you can just about make that out. If you can zoom in on that one, you're very welcome to. That's the share price of GameStop. Now, if anybody's aware of GameStop, it's a bit of an archaic company that caused a lot of problems, and the issue here is that the individuals, the rise of the individuals, caused big problems in the marketplace. And what happens broadly is that GameStop is a firm that sells through shops and it sells games. We might think they're doing really well, but they sell them on CDs or on disc, which is a bit old-fashioned, but everybody likes to download these things using Steam or whatever. I know my son does. He doesn't buy discs anymore with games. So of course their market share is dropping and their business is kind of floundering. And as you can see from the market, the sort of graphic here, the share price has plummeted since 2016-17. It's just gradually got lower and lower and lower. And what happened there, of course, is that the short sellers kicked in. Now, for those of you studying your CMAP, you need to have a basic understanding of what short selling is, and I'm going to describe that to you. And I'm going to do a little graph here. So what I'm going to do is do a little graph across here. Let's see if you can see that on your on the screen. Yeah, it's quite clear, isn't it? And this one's about short selling. Now, short selling is a method of making the most of a market that's falling. And it's dominated by hedge funds. Now, hedge funds have a bad rap, really, because people that run them tend to be stinkingly rich. But that's just the way it goes. That's called private sector, isn't it? Now, a hedge fund uses derivatives and other methods in order to maintain a particular return for their investors. They charge accordingly as well, and they are known for short selling. Now, the way short selling works is, just take, for example, the GameStop share price, and we'll have this indicating to you the share price. So that's high and that's low. And we do it in dollars because GameStop is an American company. And the whole point is that your share price is falling, and as you can see from my little graph there, your share price is falling, and over the last 3 or 4 years they have. Now, when a share price is falling, it's very difficult to traditionally make money from it, because you buy a share, hold on to it, sell it later for a profit. That ain't happening, as you can see, because it's falling. So what short sellers do, which is quite clever really in a way, is they come along and they pick a time when they think that the share price is going to fall further. So this is just a time where they think the share price is going to fall further. What they do is they borrow shares from their mates, well not their mates, from fund managers, institutions. They borrow them for a small fee, of course, small rental fee, but they actually borrow shares. So effectively what they're doing here is they're borrowing a load of shares from the fund managers, from their mates really, and they've got these lovely shares. And what they then do with these shares, because they borrowed them, is they flog them, they sell them, and they make a bit of money from that, the dollars, at that price. So they made some money at that price. But because they know the market's going to come down, they wait, and they hold on, and they wait. And what happens at some point in the future, whenever they think the price has fallen to the lowest it's going to go, is that they act at this point here. At this point here, what they do is they then buy back the shares at this price. There you go, XY. Buy back the shares, and then pay the shares back to the fund manager they borrowed them from, because they still have to return them. But as you can appreciate, what they've done is they've made a bit of profit. They've sold at a high price, bought back at a low price, therefore they've got money in the bank. They then give the shares back to the fund manager and they make profit, and it's called short selling. It's not illegal, it might be immoral, not really even moral really, but they talk about vultures, swirling around these firms and not doing so well. Anyway, cut long story short, the bit I like, actually, I love this part, is that the internet got a bit upset, social media got a bit upset, and Reddit, which is a social media platform, it brings together hundreds, thousands of small traders, small individual people like my son, who trade, not a lot of money, but they do trading. And what they decided to do was to get back at the short sellers, get back at the man with the suit kind of thing. And they started to trade in the market. And what happened is that the price of these shares, and you can see here from my graph here, the price of these shares, of course, were coming down, but because they were artificially trading in the market, it shot up, and it went up to huge figures. You can see there from the numbers, they whacked up. They're only in like a day. That's the 27th of January, 28th of January, 29th of January, because they decided to buy a load of shares, and of course they warped the market. They made the market want demand for these prices, for these shares. Increased demand, prices go up. It's any marketplace. And of course, these short sellers therefore couldn't buy. They owed the fund managers the shares, so they had to pay it back at some point. They couldn't buy them, so suddenly the price started going up and up and up. And they got to the point there where they had to buy them back at some point to pay back the guys who they borrowed them from at massively increased prices. Huge. I mean, you're talking about $400, $500 here at one point, from a low of about sort of $20. So it was an enormous loss that they incurred, and many of them weren't doing very well at all. So the Reddit mob defeated the man in the suit. It's quite funny, really. You can't make this stuff up, can you, really? Now, okay, no one's really upset because people don't have a lot of sympathy for fund managers, particularly hedge fund managers. They do what they do. But a lot of people lost a lot of money, and there's livings and there's families involved here. But it shows you the rise of the individual, and that's moving forward for the mortgage market. Beware of that. In the future, you'll have individuals gathering together to get special deals. You'll have individuals who don't want to go through intermediaries anymore and pay intermediary fees. It affects fund management, stock purchase, it affects mortgage borrowing. You'll have lenders going straight to consumers moving forward, and the banks know this, which is why they're investing heavily in artificial intelligence and small apps that can go straight to the consumer. People say, no, it's never going to happen, but it will do. It's there, the trends are there, accept it, and make sure that your mortgage business works around that concept. You can do anything in the future as long as you know roughly what's going to go on and you can plan for it. So that's a little update for you on short selling and GameStop. There we go. Hope you enjoyed that. Let's get that rubbed out for you and we'll move on to our next topic. Yeah, it makes you think, really. Something I did a few years ago is I started studying futurism and what happens in the future. And it helps enormously because you can tell what's going on. For example, training and development I knew full well was going to go online. And we started practicing and preparing for this online, a good 6, 7, 8 years ago. Because we knew it was going to change. And obviously nobody knew COVID was going to occur, did we? But it did, and of course it changed everything. So you've got to keep ahead of the curve. Got to keep ahead of the curve. Okay, let's talk about the curve now and talk about fact finding and predicting your customer's future, which is a nice little link there for you. Now, if anyone wants to type in a couple of questions, you're very welcome to. Happy to answer anything on the live stream. But this one's about fact finding. I've got a series of videos now for you on modern fact finding. Now, fact finding, as we know, is a process which involves getting facts, really. So let's give this a nice little title there for you, fact finding. It's used by mortgage advisors, financial advisors. The FCA regulates it in effect, really. Training and Competence has it built into the concept. It can be really dull and boring just by collecting facts, or it can be really interesting and can help you. All the selling's done in the fact find. It can be a series of meetings. It can be 20 minutes here, 10 minutes here. When you're using video with clients, there's no reason why you have to let them endure the 2-hour meetings anymore. That's a thing of the past. Come on, get with it. So this particular part of the fact find would certainly follow after you've got the facts. And this one's particularly useful to help you cross-sell other products, particularly protection as well. It helps you build the need for other products, because you can't just flog stuff, you have to build the need. If they have the need, you then present the solution. That's pretty much how you sell. Now, I call this one the Lifeline. Now, you might have heard it called different things, but the Lifeline's a nice little title for this. And I want to give you a demonstration how the Lifeline works. Now, the Lifeline, if I can sort of squeeze it over here, is a concept. It's been around for quite a while now, but it works really well. It's based upon the premise of coaching. When you're fact finding with a client and you're finding out about their needs and wants and desires, we coach nowadays. We don't tell people what they need. I mean, it does sicken me when I see financial advisors telling people that they need life assurance. 4 out of 5 people are going to die before the age of 70. They get a lovely poster from the Life Office. You can't tell people what to do. That's gone now. The rise of the small person Reddit didn't want to be told what to do by hedge fund managers. So you don't tell people what to do. They have to figure it out themselves, which is why we coach now. Now, I use a model called Cigar on my coaching. I don't know if you use something similar, probably. Cigar's quite smart, really, and it helps you to coach fact-finding financial needs. Basically, what it comes down to is the current situation. You've got to figure out what the current situation is the client has. Then you've got to take a look at the ideal situation the client should have. Then you take a look at the gap that is between what they've currently got and what they need. That's the gap. So then you sell that. Then you take action, and then you review. So that's pretty much Cigar. Now, the whole point here is we're working around here. We're trying to figure out what the ideal is. What's the ideal scenario, financial package for the client, is what we're coming to. Again, you can tell them what to do, or you can get them to figure it out. We do this for the Lifeline. Let me draw the Lifeline for you. It's a piece of paper, if you want it to be. Let's make sure we can keep this on the screen. Okay, it's a piece of paper if you want it to be. Other than that, it's a graph. And there's the graph for you. And what you do here is quite simple. You draw a picture. You can do it on a whiteboard if it's online using Zoom, or you can do it on a piece of paper, or whatever is right for you. A shared whiteboard on Zoom works really well, by the way, where you just get the whiteboard out and start to share it, because both you and the client can add stuff to it, particularly on Zoom. Very useful. And what you do here is you have what's called the past, present and the future. Past, present, and the future. And you have a conversation with the client about 4 specific areas of their life. So you draw along here 4 specific areas of their life. So let's just sort of draw that out there for you. Now it's up to you which one to use. I tend to go for home. So you can have a discussion about their home. You're going to have a discussion about their career or their job or whatever. Pastimes, hobbies, interests, and of course the big one, family. And you ask questions around these topics. It's as simple as that. So just take my situation, for example. If a financial advice was asking me questions around my house, and they might say to me, well, what sort of property have you had in the past? So they'd be thinking around this section here. In the past, I've owned a number of houses. I've bought about 7 or 8 properties all told. And I've bought and sold, bought and lived in the countryside with my family, my children when they were growing up. And presently now I own a property in Cheltenham with my fiancée Shelley, and we bought the house together, and we're very comfortable here in Tivoli and Cheltenham. It's terrace property, and we're very comfortable. And you might ask me a question about what I'm doing in the future. Well, in the future we're probably going to stay in the property in Cheltenham because it's easily rentable. It's quite close to GCHQ, the new cyber park, so if we do decide to move around the country or the world, then we can rent this property out very quickly and easily. It's got 3 bedrooms plus the basement, studio, and all sorts of things going on for it. So where might you live in the future? Well, that all depends. We're looking to purchase some properties down in Cornwall, but they're more of an investment. They're more for your pension. They're more for the future. So some buy-to-lets, some holiday lets in Cornwall. But we might live down there at some point. Maybe buy a property down there or rent a property down there, rent this one. So you're asking questions about the customer's future. Then you might ask about your career. So how did you get to where you are, Mr. Archer? Well, I've set up my own business in 2000, and I've been self-employed for 20 years running my own business, enjoying it, etc. They might ask Shelley some questions as well. So it's a joint situation, this Lifeline. You look at the collective. And where are you now? Well, obviously I'm managing director of the company now, Archer Training Limited, and we operate 100% online, and we deliver training and education skills to financial advisors, mostly mortgage advisors, people with professional services, if you like, people that use their nonce, their brain, and they give information to clients and the clients pay for it. That's pretty much what we help people to do. What about the future? Well, the future, nobody really knows, but we're definitely going to remain online. I'm going to do a lot more writing moving forward, a lot more videos, a lot more 3-dimensional stuff, the virtual reality type training as well, using the internet. And I'll probably be able to work on to about sort of 75 plus is the plan. You see what's happening here? You're just getting a picture for the client's details. If they're a young couple and they want to start a family, or start to see how the family is going to evolve. The hobbies is an interesting one. What do you like to do in your spare time? What do you get up to? Well, we do a lot of walking, particularly in the Southwest Coast Path. Enjoy that very much. We like to go out to restaurants and bars when they're open, so you can find out a bit more about the future. Now, once you've got a picture of their situation, you can then decide what is the ideal for them. What ideal cover do they need? Do they need some life assurance, for example, because they've got some young children? We've got a mortgage till age 70, so I need some life assurance to cover that. And we certainly like to do a lot of walking, so you want to make sure you're fit and healthy. Maybe some private medical insurance to make sure you're fixed quickly. If you're self-employed, of course, you don't have any benefits in kind, so you're looking at health insurance. So you're getting a picture of the ideal by looking at the present and the future. But you're doing it through a conversation. And at this point, you can start to talk more about the gaps if you wish to. So where's the gaps now? Now you know the customer's life, where are the gaps? And you can start to disturb the gaps. So, Mr. Brown, noticing that you've got a young family there with no life assurance, what would happen if you were to die? What would be the impact on your family? How would it affect you? How would it affect your hobbies? Because you can relate to what you've actually brought out from them as well. Very useful in the later life market, in fact essential. The FCA are on this like a rash at the moment. They're worried about the longevity of the advice. A lot of mortgage brokers are so keen on the 2-3 year fixed rate sort of turnover churning kind of thing that they regard the equity release market in the same way, but it's very different. Equity release is very long term, so you've got to make sure the advice you give is pucker for the future on the later life market. And unless you ask them questions about the future, even if the person is age 70, people have got long life expectancies now. Find out about what their plans are, what they want to do in the future, where they want to move to, where their family is, what their grandchildren are doing. And then you can get a rough idea of roughly where you think the client's going to go. So for example, if they are definitely going to move away in 4 or 5 years' time to a property down by the coast or something, they've indicated they're going to do that, then you don't want to be looking at a long-term equity release product, because you won't. You want to look at something that gives more flexibility, maybe a Rio or something like that. But you see what I mean? You're finding out about the customer's life in a soft kind of way, and that's the beauty of Lifeline, and that's why it's very, very powerful. It doesn't have to be long. Doesn't have to take a long time. One client I'm working with in coaching, he uses Zoom to talk to his clients. He uses the shared whiteboard. He already has one of these things set up on the whiteboard, and he writes things in there as the client gives answers. The client writes stuff in as well. So it's very interactive, really works well online, oddly enough, and to get a good picture of the customer. And remember, once you've got the gap and the client sees it, remember, coaching is about pulling. You're pulling the client to realise where the gaps are, what the ideal is, what they need, and then of course it's down to you to do the closing, the action, see about affordability and stuff like that. But very useful method to use as a mortgage advisor, financial advisor. I'd definitely be using this if I was you. Great, hope that's been useful. Bye. Hey, nice one. Good. How are we doing time? 20 past there, so useful live stream today. Hope you found that useful. Remember, we're giving you away the latest information, not holding back. It's the right thing to do now. And we've got our spring Mark 1 cohort starting on the 1st of March. Now what this does, if you're studying for your CMAP exams, is it gives you massive structure, lots and lots more videos online using a portal. It's all your own codes that to go on there. And we guide you through it over a 3 to 4 month period. That's why we're a cohort. We've got 25 people coming on board. We meet up weekly for live video streams and chats and conversations. I encourage people, I answer questions. I kind of mentor you all the way through your CMAP exams. Because sometimes it's not easy, is it? You pick up a book, you can watch the video on YouTube channel, but you just need a bit of boost, a bit of motivation. Mojo's a bit low at the moment, isn't it, with lockdown? So the whole point about the cohort system is that we help you to get those exams. We guide you along, we encourage you, we give you live streams, we answer your questions. You get access to the portal, which has hundreds of hours of video. I mean, our video covers pretty much the whole syllabus. We don't just look at key points, which the LIBF do. We don't look at just 1 or 2 things for you. We look at all sorts of areas. So if you really love the video, you get a load of learning from that as well. It's quite enjoyable. If you like my style, this is exactly what you get on the bootcamp. Starts on 1st of March. We've got 22 spaces left, so you'll need to go down to the link there. It's in the bottom bit there. Subscribe to the channel as well while you're here. Be happy to have you on board. But the places are going quickly because people want to get this here. The mortgage market's booming, so people want to become mortgage advisors. And we help you beyond that. We don't just teach you to pass the exam. That's actually the easy part. We guide you through the next stages. We give you sales skills. We give you mentoring. We put you onto networks and things like that along the way. We really help you because we want to get as many new people into the mortgage industry as possible. As much new blood, new thinking, new ways of doing things. The old way is old-fashioned now, isn't it? We've got to get modern. The world is changing. The mortgage market is changing more than it's ever done in the next few years, and people don't know that. Can't see it yet. They think it's going to be the old ways of doing things. It's not. You've got to be up to date, and we'll make sure you're there as well, keeping you ahead of the curve. Anyway, enough of that. Hope you've enjoyed the live stream. We'll be back next week. We're going to do mortgage fact finding part 2 and part 3 for you. So I've got some more ideas about how to make your fact finding more eventful, more enjoyable, and therefore more successful for the client's needs along the way. Paul Archer, see you soon. See you next week. Have fun.